Hello, I'm Nathan Kubik, and thank you for joining us for the end of the first quarter of 2022 Transform Wealth Capital Markets Review. I hope everyone is doing well and enjoying the onset of some new warmer weather. A lot has happened in this first quarter, and we have a lot to talk about. Today, we will be discussing these recent events, what we are currently observing in the financial markets, as well as the key influencing factors moving forward. After a discussion on potential impacts from those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. The volatility we have seen this past quarter can be attributed to a number of economic and geopolitical factors that we will get into throughout this presentation. These factors have shifted meaningfully from those over the past couple years, and COVID-19 is no longer the primary factor. While still an important consideration, the current most impactful factors have been inflation, interest rates, and the Russia-Ukraine war. To date, domestic corporations are continuing to perform well, but it is important to understand the potential implications of each of these factors and the risks they present. Before jumping into that, let's walk through a quick recap of what we've experienced. In 2020, the year of coronavirus, the S&P 500 returned a positive 16%. This was followed by 2021, where the S&P 500 returned a whopping 27%. The world continues to be impacted by the virus, and one of those impacts is through supply chain issues. Most had believed that the inflation we were witnessing was transient, and that supply chain issues would be fixed in relatively short order. As it turns out, that was not the case, and we are still dealing with some supply chain issues. Further, there are now some additional compounding factors. To that end, earlier this year, it became apparent that inflation was becoming an issue that needed to be addressed, and the Federal Reserve began to set forth the expectations of raising interest rates to combat that inflation. This topic took center stage during a more typical market pullback, and was further compounded by the invasion of Russia into Ukraine. Since then, the resiliency of the markets have begun taking root and have been working to reestablish a foothold and work their way back up. On this slide, we consider each calendar year's S&P 500 return going back to 1980. As you can see, intra-year declines occur with an average of 14%. In the first quarter of 2022, we saw an intra-year decline of 13%, which did recover back to a negative 5% by the end of the quarter. While there are a number of factors that still present risks to the market, we did want to show you this in efforts to show you that to date, 2022 is in line with historical averages. Now, before jumping into the current market driving factors, we did want to show you the current state of COVID-19. As depicted in the chart on the left, case levels are down to minimal levels, as are fatalities. And looking at the chart on the right, we can see that hotel occupancy is back to only 6% below pre-pandemic levels, and seated dinners are back to 3% below pre-pandemic levels. TSA travel traffic is still down 11%, but part of that is thanks to virtual meetings and corporate travel changes. COVID will remain an important factor of consideration going forward, but for now, the attention of the markets has shifted to some other factors. One of which is the war in Ukraine. This is a terrible situation, and one that is hard to believe is occurring in today's day of age. Surprisingly, the domestic equity markets are actually higher today than they were when the invasion began. That said, there are some relevant market implications and some potential risks down the road. The largest risk is that of an escalation in war against Russia. At this point, this does not appear to be the case, and the market consensus is that the conflict will continue to be confined to Ukraine. However, it is important to recognize that what comes next is an unknown. The implication of the war on energy prices is very apparent. And while the US is not dependent on Russian oil, Europe and China have been. This is one of the reasons we've seen the spikes in oil and gas prices. This is also one of the causes for the inflation that we've been witnessing. And inflation is at the heart of what's been driving the volatility that we've been seeing in the markets. The notion of this being a short-term transient blip has become less likely, and we've seen inflation jump to levels not seen in 40 years. Here, we consider the most commonly referred to inflation metric known as the Consumer Price Index. This metric measures the average change in prices paid by consumers for a market bucket of goods and services. And as you can see, it has hit a level of 7.9%. But let's dig into that number a bit. On this slide, we consider the primary underlying buckets of CPI. As you can see, some of the inflationary buckets may prove to be transitory. Buckets like energy, new and used vehicles, and food at home. Others may prove to be a bit more sticky, areas like leisure and homes. Whether they are transitory or sticky is yet to be seen. But remember, the main concern for inflation is not that prices are now higher. Instead, the concern is whether or not those prices will continue to rise. Time will tell, but our current positioning is in line with consensus estimates, and that is that inflation will continue to grow throughout the year, but that it will lessen to more normative levels sometime next year. The U.S. job market continues to be incredibly strong. Looking at the chart on the left, we see that job openings remain at very high levels and that the great reassessment has continued. Layoffs remain incredibly low, and people leaving jobs for new ones remain at high levels. This has resulted in unemployment rates dropping to near pre-pandemic levels and a corresponding increase in wage growth as companies struggle to find employees to fill needed roles. This too is a contributing factor to inflation and one that will continue to be important to watch. As a result of this inflation, the Federal Reserve has recognized the need to use some of their tools to dampen inflation. This is a primary focus of the Federal Reserve. Remember that the easy and cheap borrowing availability set forth by the Fed's policies throughout COVID have indeed exacerbated the inflation issue. As a result, the Federal Reserve has begun raising interest rates and has been clear that more rates are coming. As a result, all fixed income yields have correspondingly risen. This is a go-forward positive for investors in bonds, as they will now realize a greater rate of return. However, this is a negative for people looking for a mortgage and for companies needing to borrow money now at higher interest rate levels. Another factor worthy of note is that of consumer sentiment. This is an economic indicator that measures how optimistic consumers feel about their finances and the state of the economy. As you can see, we are at unusually low levels. This chart looks at sentiment bottoms and the subsequent 12-month returns of the S&P 500. It is possible for sentiment to go lower or for it to stay low for a period of time. So this is not necessarily an indicator that the next year will have positive returns. But it does tell us that consumers are not overly optimistic, nor is it likely that they are acting with irrational exuberance. Also worthy of note is that many of these sentiment bottoms occur with a recession, something that the recent yield curve inversion also can be indicative of. A recession is technically 2 consecutive quarters of negative GDP growth. This can be seen in the 2 dips of the chart on the left. To date, this has not occurred, and the U.S. economy has continued to drive forward, nearing its historical trend line of growth. And while we do not believe a recession is imminent, we do recognize that the myriad of factors we are discussing do have the potential to increase the chances of that possibility. And to your question, the answer is yes. We are positioned and will continue to position our investment strategies with this in mind. But it is important to remember that domestic companies are continuing to perform. There are headwinds ahead, specifically related to supply chain, inflation, and interest rates. However, the consensus of analysts continue to believe that earnings growth will continue. Additionally, the recent pullback in the markets has reduced valuation metrics even while earnings grew meaningfully. Earnings have continued to grow into market valuations, and this has been further expedited by the market pullback. If the consensus of analysts is correct in earnings expectations, this trend should continue, and valuation metrics should move back further towards historical averages. And while current market valuation metrics remain higher than those averages, it is important to keep in mind that there is still a wide disparity in valuations of individual companies within the market. We do believe there are many overvalued companies that do not justify their valuations. Looking at this chart, we see that there continues to be an extremely wide disparity in valuations within the 505 companies in the S&P 500. This chart weeds out the top and bottom 20% of extremes and considers the remaining 60%. This continues to be a wider level of disparity than typically witnessed, and we believe this is an opportunity for prudence and an increased focus on fundamentals that will be rewarded. We continue to be focused on U.S. companies as opposed to the rest of the world, and this has been further reinforced by the current war in Ukraine. In this chart, the blue line represents the S&P 500 and the orange line represents the rest of the world. The outperformance of the U.S. versus the rest of the world has continued, and we are being rewarded for our decision to avoid international exposures. From a style perspective, large cap value has taken leadership in the first quarter. In a market pullback, this is generally typical. With a flight to safety, investors often seek the safety of large cap and value-oriented companies. Additionally, some of those overvalued growth-oriented companies that we've discussed on that disparity slide are often punished during these time periods. We were well positioned for this shift and now feel a more neutral stance to be prudent going forward. Here, we consider our current style weightings. There are a couple of factors worthy of note. The first factor is early in the quarter, we were at a near neutral weighting between value and growth. During the quarter, some of our holdings had style categorization shifts within the quarter. Most notably was Apple. Apple's growth and rewarded valuation metrics shifted it from a large cap core company to a large cap growth style box. This makes our style weightings seem more growth tilted than what they were throughout the quarter. The second factor to consider is that our actual company exposures reside in subsets of each style box. Specifically on the large growth side, we are currently avoiding the high flyer PE stocks and are focused on GARPy companies. GARP is an acronym that stands for Growth at a Reasonable Price. This focus could be considered the more value-oriented subset of the growth style box, and we feel those are well-positioned companies for the future. Lastly, we do maintain a buffer cap strategy. It's a defensive hedge strategy within the portfolio, one that we're using with the intention of dampening volatility, which has also served us well this past quarter. From a sector standpoint, our current overweights are in financials, materials, and healthcare. Our current underweights are in communication services, real estate, and utilities. Utilities was the second best performing sector after being the worst performing sector last year. This performance is primarily due to the flight to safety during a market pullback. However, our concern is that their sought after dividend payments will come under pressure as interest rates rise going forward. I will also note that we started the quarter with an overweight to energy and did pull back on that slightly as prices continued to climb. We are still in the process of making some adjustments within that sector. And those specific target weights can be seen here for our core equity model. As mentioned, we continue to have underweights in communication services, utilities, and real estate. We are in the process of tweaking a few of the underlying holdings in this model and feel good about our exposures as we move forward. With the flight to safety, the dividend model was especially well positioned for this past quarter. This strategy has an inherent tilt towards large cap value, and we do believe that these types of companies have stronger fundamentals and that their valuation metrics also remain relatively attractive to the market as a whole. While this model will not tilt towards growth like the core model, we are still looking for growth characteristics within the value space. Additionally, like the core equity model, we also continue to hold a defensive portion within this model to the buffer cap strategy as well. We are also aware of the implications of inflation and potentially rising interest rates on dividend-paying companies and are thoughtfully positioning with this in mind. On the bond side of things, we have already discussed the causes of the upward movement with yields. As you are all aware, we have been positioned defensively from an interest rate risk perspective and have discussed the need for patience for the last year or so. We have discussed the minimal upside in yield for extending our portfolio duration and the corresponding interest rate risk associated with such a move. We have discussed all the reasons for our current positioning as it relates to tapering and to interest rate hikes. This positioning is now rewarding our clients as interest rates have begun to move. We are now beginning to take advantage of this shift, but not in an aggressive manner. We expect rates to rise further and are being thoughtful in our first stage of deployments. On this slide, we consider the historical Fed fund rate levels as well as the future expectations set forth by the FOMC and from the market as a whole. As you can see, over the next couple years, both the FOMC and the markets expect the Fed fund rates to continue moving upwards. This coincides with the guidance set forth by the Fed. This scenario is what we've been positioned for, and we expect the rest of the yield curve to move upwards as well. If these expectations occur, investors will benefit from a higher yielding bond market. In this slide, we look at the impact of this past quarter's rise in interest rates and its impact on different types of bonds. Remember that the market value of bonds is really a time value money equation of future coupon and principal payments. Thus, the longer the life of the bond or its duration, the more impact a change in yield has on the price of a bond. There is an inverse relationship between yields and current market value of bonds. Simply put, as bond yields rise, the current market value of the bond declines. Of course, the future coupon and principal payments remain fixed, but this scenario creates a meaningful opportunity, and one that we have specifically been positioned for. In looking at this slide, you will see that bonds with a longer duration have declined more meaningfully in value than those with shorter durations. Hopefully this paints a picture of why our shorter duration positioning was so effective in this market cycle. And now the key will be when to lock in longer rates and what types of bonds and structures are most optimal for the environment moving forward. In addition to the future expected rate hikes, the government's continued purchasing of bonds is expected to decline as well. Remember, this was a quantitative easing measure put in place during COVID to normalize dislocations in the markets and keep interest rates lower. Tapering is already occurring and is expected to continue as depicted in the chart on the left. As we have discussed in the past, this expected decline will increase the supply of bonds for the sale in the market, which has the potential to push yields up as well. So while the yield movement to date has created some opportunities that we have been tactically positioned within, there is reason to believe that rates can move higher, and we are positioning with all of this in mind. Lastly, we thought it might be interesting to share the historical implications of rate hikes and the corresponding performance in the S&P 500. While there are certainly concerns given inflation, interest rates, and the war, a rising interest rate environment does not necessarily imply a negative for the equity markets. As you can see, over the last 6 rate hiking cycles, 4 of them resulted in a net positive during those periods of those hikes. So in conclusion, given all available indicators and economic data, we continue to feel well positioned in each of our strategies. While it is likely we will continue to witness some volatility as we move forward, we feel strongly about the companies we currently own and the way we are positioned going into the remainder of the year. We remain focused on potential risk exposures and are prepared to reposition should indicators shift further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, Thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented. Take care, and we look forward to speaking with you soon.